Hi, welcome back. I'm old enough to remember the 1987 crisis, the 1999 dot-com correction, but most of all, the 2008 market crisis, because it shook my faith in things I thought I knew. And one of the things I learned coming out of the market crisis is I hadn't been paying enough attention to the price of risk in equity markets, and especially so in mature markets. Prior to 2008, the belief was, and this was mine as well, that in a mature market, risk premiums don't change very much over short periods. And 2008 changed that. So coming out of that crisis, I made a couple of resolutions. The first was, rather than compute the equity risk premium for the S&P 500 at the start of every year and using it through the course of the year, which had been my practice until 2008, that I would compute the equity risk premium at the start of every month. And I've kept that resolution. In fact, at the start of July of 2024, the equity risk premium for the S&P 500 had dropped to 4.11%, the lowest value I've seen since the 2008 crisis. The other thing I resolved to do was every year that I would update my equity risk premium thoughts. And those took the form of a paper that's grown longer and longer each year. So my first paper is on equity risk premiums in general, what drives them, what makes them move, and what the best way of estimating them. And I do that at the start of every year. Usually around March, I do an update, and my 2024 equity risk premium paper was updated in March of 2024. The other thing I focus on is equity risk premium across countries, because that's the other thing that we learned coming out of 2008. We're all connected at the hip. So the middle of every year, I update this paper on country risk and equity risk premiums across countries. And this session is primarily about that update. The links to the paper are available if you check out at the end of this YouTube video. There is a link to the paper if you want to download the paper. Not a warning, it's long. It's more than 100 pages long. It's extremely boring, but it includes everything that I know about country risk and equity risk premiums. So let's get the process started. Are there differences in equity risk across countries? Obviously. That obviousness, though, doesn't stop people from ignoring it. In fact, there are people who argue that you can ignore country risk because you can diversify it away. In other words, if you're in 60 different countries, since the countries move in different directions, they can average out. That used to be the prevailing belief before 1987. But we no longer believe that because the data is getting in the way. Markets are correlated, so even if you're in 60 different countries, when you have a global crisis, they all move together. I'm going to argue and present some evidence that there are differences across countries in risk because of four major factors. One is the political structure of the country. And for lack of a better differentiation, I'm going to differentiate between democracies and authoritarian regimes and which one creates more risk. The second is exposure to war and violence, and varies across countries. The third is the extent of corruption in a country. And the fourth is the protection for private property rights and the legal protections that you have. Now, in talking about these factors, I'm most interested in the economic risk that comes out of them. So I don't take any of the discussion to be a cultural or social discussion. I'm not talking about whether democracies are better than authoritarian regimes, but I'm going to look at it purely through the perspective of businesses and investors. So let's start with political structure. Broadly speaking again, you can think about differentiating political structures in terms of the degree of freedom it offers individuals. Authoritarian at one extreme and extremely democratic at the other. At the outset though, if you ask me which one is better to be a business in or invest in, the answers are surprisingly mixed. Each one brings its pluses and minuses. The advantage of democracies is you have governments that are responsive to people, are less likely to be arbitrary and more accountable because there are systems in place keeping their powers in check. But policy changes continuously. Why? Because in a democracy, governments change. No democratic government can promise you regulatory or tax laws in perpetuity or even over a long period, because the next government can change it. In contrast, an authoritarian regime can promise you economic policy that is stable and predictable and deliver on it. That's good, right? For a business or an investor, but it comes with a catch. When change happens in an authoritarian regime, it tends to be wrenching, it tends to be large, often catastrophic. So what you have is a choice of what kinds of risks you want to face as a business or an investor. Would you rather face the continuous risk you have in a democracy, or the discontinuous risk and unpredictable risk that you have in an authoritarian regime? We've seen this contest play out over the century in business and investors investing or operating in India or China. And for much of the century, China won out. In the last 5 years, the pendulum has shifted somewhat, and I would expect this back and forth to continue. So first chart I'm going to start with looks at democratic, it's an index of freedom across countries, and it's, whenever you create these indices, it is affected by the biases of the measuring service. So if you find yourself disagreeing with where your country is categorized, please don't take issue with me. This is the Economist score of freedom, and the higher the score, the more freedom there is. So as you can see across the world, there are areas of red, a lot of Africa, a big part of Asia, more authoritarian than democratic. And North America, Australia, parts of Europe are more democratic than authoritarian. Now, as you look across the regions of the world, you can also look at trend lines. And as you can see, there is no natural trend towards more freedom. In fact, if you look between 2006 and 2023, the global degrees of freedom have actually decreased. There's been more of a shift towards authoritarianism across the world. So file that away. There are differences in political structure across the world. Second, let's talk about violence. Why does it matter to business and investors? It's much more difficult to operate a business or invest when you're exposed to war and violence. That war and violence can be from within, when you have civil wars within a country, or if you have just crime out of check. Or it can be from without, when you have wars. Because when you're exposed to war and violence as a business, you have two choices. One is, if you can, and it's not always possible, you can try to buy protection. Try to buy protection or buy insurance. That's going to cost you. It's going to become an operating expense that reduces your profits. In much of the world, you cannot buy protection. There will be no insurance, in which case you will have lost sales and fewer businesses being started. So here again, I'm going to give you an index, and this index again reflects the biases of the measure. It's from an institute called the Global Peace Institute, which measures the degree of violence to which a country is exposed. The higher the number, the more violence you're exposed to. As you can see again, parts of Africa, much of Russia and Eastern Europe are the most exposed to violence. But there are a few surprises here. While India and China are exposed to violence, so is the United States. In fact, if you look for the safest parts of the world, it's Canada, Australia, parts of Europe. So again, violence we're looking at through the prism of business and investing, and you can see the variations across the world. Third, let's think about corruption. Why does corruption matter if you're a business or an investor, and especially if you're a business? Corruption operates as an indirect tax. A tax in what sense? To operate, you've got to pay bribes. Those bribes are a tax paid not to the government, but to the middlemen. So as you look across the world, again, there are services that measure. This is a corruption index. It's measured by a service called Transparency International. And again, the red parts are the most corrupt parts of the world. And here, the lower the score, the more corrupt a country is. The higher the score, the less corrupt. So if you take out North America, Australia, and Europe, much of the world, as a business, you're facing up to the threat of corruption. You can also see the list of the least corrupt and most corrupt countries in the world. The least corrupt have a disproportionately large number in Northern Europe. And before you attribute it to cultural factors, Singapore is on that list, which shows you that while it's often easy to blame culture for corruption, I think the roots of corruption lie in two forces. One is the degree of rules and licenses. We have to go to somebody to get permission. And the degree to which you underpay the people who approve those rules. If you underpay the bureaucrats who manage these systems, you are going to get corruption. Again, wide variations across the world. Which brings me to the fourth factor, which is if you operate a business, you are dependent on the legal system to protect your property rights. In other words, as a business or an investor, if governments or others can take away your property, there is no value to your property. Again, there is a service. And this is from the property rights, which measures property rights protections across the world for both physical and intellectual property, and comes up with a composite score, which is the IPRI index you see here. And if you look across the world again, you see the wide variance. Australia and the US and parts of Northern Europe again have the strongest protections for property rights. Much of Latin America, protections are much, and Africa, the protections are weaker. And in Asia, you can see that India and China have made strides, but protections are again weak. Now, why are protections weak? Part of the reason might be the laws protecting private property might not be very strong. The other is, even if the laws are strong, if you have a legal system that takes forever to enforce property rights, decades rather than months, what's the point of getting protection if you're going to get your property back 35 years from now? So again, wide variance across the world. And as a business, if property rights are weaker, you're going to be less likely to start businesses, and your business are going to be worth less. Now, those are four factors that you can think of self-created. In other words, you can, as a company, improve yourself on those four factors. And Singapore is a classic example. When Lee Kuan Yew became, when Singapore was created as a country, it looked like the rest of Asia. It had violence and corruption just like the rest of Asia. And Singapore has managed to make strides to become one of the least corrupt, the strongest protection for property rights around the globe. Now, the reason I bring that up is, while those are factors under your control, some are not. Incidentally, under property rights, there is an extreme variant of loss of property rights, which is nationalization. And much as I would like to tell you that nationalization risk has gone away, it's not. It's mostly concentrated in natural resource companies. And this graph actually looks at how much nationalization risk has deteriorated. In fact, the risk has gone up, where it stayed stable. And you can see there are parts in the world where the risk of nationalization has actually gone up over the last decade. Now, why might that be? One reason is, in many of these cases, the national interest becomes the motto that governments use to nationalize natural resource companies. Just a few years ago, in 2021, the Mexican government announced that it was nationalizing the lithium mining business in Mexico, primarily for national interest. Now, whatever the interest, to the extent that your property can be taken away by the government and you're given token compensation, that's a loss of property rights. Now, of course, all of these forces governments can improve on, but there are some things where governments really can't help themselves. In other words, you're going to be exposed to country risk whether you like it or not, even if you have a good government working in the right directions. And I want to focus on three things that can increase country risk where you might not have much control over the outcome. The first is that as a country, you're over-dependent on a commodity or commodities for the economy to do well. You are more exposed to country risk. The second is, I'm going to borrow a structure that I use with companies, life cycle, and talk about where a country is in the life cycle can affect its country risk, and often that effect is out of its control. And the third, and this is something that I've added to my country risk components in the last few years, is climate change is here, and we can debate whether it's man-made or whether it's nature-made. But wherever you fall in the debate, to the degree that the globe is getting warmer, and if you accept that as a proposition, different parts of the world are more or less exposed to climate change, and that could affect country risk. Let's start with the first one. This is from a UN agency which looks at how much countries are dependent on commodity or commodities. And the way they measure it is what percentage of your exports come from commodities. And if you look at the parts of the world that are most dependent on commodities, well, it turns out that Africa, almost every country is dependent on a commodity or commodities for much of its exports. And you can see the same phenomenon in parts of Latin America. Now, of course, there are significant parts of the world, Europe, North America, India and China, where you don't see that dependence. Incidentally, Australia is also dependent on commodities. Now, your response might be, why don't countries work at reducing their dependence to commodities? It might not be a choice. If you're a large country with a large population, like India, like China, it is possible to diversify your economy. You have a large market that you can service. But if you're a country like Peru, or if you're a country like Chile, Much as you try to diversify your economy, as a small country, you need to find a niche, and your niche might be a commodity. In fact, I would argue that when you're dependent on a commodity, that is one of the first factors that keeps you from diversifying. Is if you're a small country, it's difficult to. The other is, if you're a country where you can make a lot of money easily on a commodity, it becomes so much more difficult to compete for capital if you're any other business. I mean, look at the Middle East. For decades now, the Middle Eastern countries have tried to diversify away from oil, but it's very difficult to do so. So as you look at commodity dependence, it varies across the world, and some of these countries will stay dependent on commodities no matter how hard they try. The second is the notion of a life cycle. I've used this notion to explain why companies change over time, but countries go through a life cycle as well. So when a country just starts off, its economy is just, think of it like a startup. You can be a young growth economy, a high growth economy, a mature growth economy, a middle-aged economy, and then you go into decline. Depending on where you are in this life cycle as a country, your risk is going to shift. Early in the life cycle, just as with companies, countries are selling stories about who they will be. And at least early on, you're going to be exposed to a significant amount of risk because everything is in the future. Young growth economies will be exposed to more risk than more mature economies. So remember all those graphs where Northern Europe and Australia and Canada look safe. They're safe because they're middle-aged economies. And herein lies the catch. There's an old saying in investing, you cannot have gain without pain. If you want safety as an investor, you're going to be inclined to invest in North America and at least in Canada, Australia, and perhaps in Northern Europe. You'll get your safety, but don't expect growth. If you want growth, you're going to be seeking out the riskiest parts of the world, Africa, Latin America, parts of Asia, because that's where the growth is. So before you dismiss the riskiest countries as not on your radar, think about what you're giving up. Thirdly, let me focus on climate change. This is from, again, a service called Natural Resource. It's a service that measures climate risk across the world. And the higher the score, the more exposed you are. So again, take this with a grain of salt. This was the 2021 picture they drew of which countries were most exposed to climate change. As you can see, Africa by far is the most exposed, followed by Latin America and chunks of Asia. In fact, there's an update expected on this graph in 2024. I'd be interested to see whether this climate risk exposure change across the world. And as businesses and investors, this has to be factored in somewhere in your investing, right? Because if climate change is going to make it more difficult for people to live, for businesses to operate, it has to affect whether they operate and how much you value them at. So that's a lead into why country risk varies. Let's talk about how to measure country risk. The most commonly used measure of country risk is sovereign ratings. The ratings agencies, Moody's, S&P, Fitch, while they rate companies, also rate countries. They're called sovereign ratings. Now, I'm not going to argue that ratings agencies are not without fault. They make mistakes. Sometimes they're biased against regions. But I think the biggest problem with ratings agencies, they're slow to act. That said, though, they provide ratings for 130, 140 countries. It's easily accessible. It's free. So this is my start. I start with the ratings. I'm using the Moody's ratings across the world. Again, the red parts of the world are the lowest rated, the highest risk countries. The green parts of the world are the safest. Remember, ratings focus on default risk and default risk alone. So if you're wondering why Saudi Arabia looks safe, from a ratings perspective, it is safe. There is very little default risk. Again, the safest parts of the world, Australia, US, Canada, Northern Europe. Southern Europe has pockets of default risk that have opened up. India and China, which used to have much larger default risk, have scaled down and are much safer than they used to be, and you can see them in light shades of green. Africa and Latin America still have variance in risk. Incidentally, while we put countries into regions, there are wide variations within each region. So I don't want to color any region with high risk because there are countries within that region that can prove the exception. So that's my starting point, sovereign ratings. Of course, if you don't like ratings agencies and you believe that they're biased and that they're late to the party, There is an alternative, a market-based alternative that has emerged in the last 2 decades. You can buy protection against default risk in a market called the sovereign CDS market. Again, it's an imperfect market. It has its flaws. But the advantage of a market-based measure, it reacts quickly. The disadvantage, it sometimes overreacts. It's available for about 80 countries, unlike ratings which are available for 130, maybe even 150 countries, only 80 countries. I've highlighted the countries where they're available. Again, the red parts of the world are the countries where the market-based default risk is highest. Again, you see pockets in Africa, Latin America, and the green parts are the safest, at least based on the market. Again, notice the transition that India and China made. And just as a note, this is the first year in my recording of this data that India has had a lower sovereign CDS spread. That's a measure of default risk that this market attaches than China does. Whether that's temporary or not, we're going to see. But again, it's a market-based measure of default risk. Now, both ratings and sovereign CDS spreads measure default risk. But let's face it, economic risk in a country comes not just from default, it can come from politics and other economic risks. So there's a second way you can measure country risk, and that's with country risk scores. There are a number of services that I know of that measure country risk. There's the World Bank, there's the Economist. The service I've been using, and I'm not going to argue that this is better or worse, it's called Political Risk Services. And I'm most familiar with it, so I'm going to stick with it. So what Political Risk Services does is it takes multiple dimensions of risk in every country and comes up with one score for the country. That's called a PRS score. The higher the score, the safer the country. Now, one thing to note about political risk scores is there's no rhyme or reason for why it has to be low to high or high to low. There are services where high scores suggest high risk and low, but at least for PRS, high scores are safe and low scores are risky. Again, I've highlighted the parts of the world that look riskiest to PRS. Lots of Africa, chunks of Latin America. The US, surprisingly, is riskier than many other parts of the world according to PRS. Now, I have to tell you that there are parts of the world where I don't agree with the PRS score. Libya, for instance, has actually looked safer to PRS than the US, and I don't buy that. But it's, to the extent that it is, again, a score you can measure across time, you can look at how that risk has changed over time. So you got ratings that measure default risk, country risk scores that measure all risk. Now, I am interested often as an investor, as a business, and when you're invested in country risk as an investor or business, you don't care about default risk per se or country risk scores. You want a risk premium. What would I charge as a premium for investing in this country? I call these these are basically equity risk premiums. I've been updating my estimates of equity risk premiums by country every year now for almost 30 years. And in July of 2024, I'll go through the process by which I estimated equity risk premiums by countries. I start with the US, not because I'm being parochial, but because I think the S&P 500 gives me the best way of estimating the equity risk premium for a mature market. At the start of July 2024, as I mentioned earlier, that equity risk premium was 4.11%. This is an implied premium backed out of the S&P 500. I start with that number. Then I look up the sovereign rating for your country. If it is AAA rated, I give you the same risk premium as I did for the US, 4.11%. So Germany, Netherlands, Australia, Singapore, you're going to see 4.11%. If you're not AAA rated, I'm going to look up the default spread based on your rating. And I have a table where if you tell me what your rating is, BBB, BB, I look up the default spread. And then I scale up that default spread by the fact that equities are riskier than government bonds. You're saying, how do we measure that? I use two indices. The first is a standard deviation of an emerging market equity index. It's an ETF. The second is a standard deviation of an emerging market government bond index, and I look at that ratio. In July of 2024, that ratio is 1.30. What does that tell me? Equities in emerging markets are about 1.3 times more risky than government bonds. So if your default spread is 2%, I multiply by that 1.30. I come up with 2.60%. I add it to the 4.11%. I've got an equity risk premium for your country. And I do this for every country where there's a rating. For those countries where there's a sovereign CDS spread, if you go to my spreadsheet, I actually have an alternate measure based on the sovereign CDS spread. There are some countries which are unrated. They're called frontier markets. Why would they not be rated? Because they're so risky that ratings agencies don't even want to start. Syria, North Korea, Sudan. For a long time, I used to ignore those countries. I no longer do. I use their PRS scores. Remember, I talked about them. I look for other countries with similar CR scores which have a sovereign rating and an equity risk premium. And I use that composite equity risk premium. So basically, I have an equity risk premium for countries which have PRS scores. What happens if you have a country which has neither a rating nor a PRS score? You're out of luck. I just have to give up on those. So this is what the world looks like to me in terms of equity risk premiums. And again, if you are from one of the countries which are in red and you don't like my equity risk premium for you, please remember that it's not my fault. I'm starting with a Moody's rating, and to the degree that your rating is bad or your PRS score is low, I'm going to give you a high equity risk premium. Again, you can see that Africa has some of the riskiest, highest equity risk premiums. Latin America is a mixed bag. As you can see, Argentina still has a high equity risk premium. Brazil is lower, but parts of Latin America are in shades of green. India and China, the equity risk premiums have declined over time to look very much like Southern Europe. In fact, you could argue that if you're given a choice between investing in Southern Europe and India and China, it's a close call. Australia, the US, Canada end up with mature market premiums, as does Northern Europe. So again, take it with a grain of salt because it's built on default spreads, but those are my measures of equity risk premiums by country. Let's get down to brass tacks. What am I going to do with these equity risk premiums? Well, I'm going to argue that whether you're a business or an investor, these matter to you. As a business, why does it matter? As a business, one of the fundamental and perhaps the most fundamental decision you got to make is the investment decision, where you have to decide what projects to take, what investments to take. And the basic rule in corporate finance is you have to earn a return on those investments that exceeds a hurdle rate, what you need to make given the risk in that investment. So to make judgments on investments, you need hurdle rates. What goes into a hurdle rate? Three things. One is the currency you choose to estimate your hurdle rate. And I'll come back and talk a little bit more about that choice. But if it's in US dollars, you're going to start with a US dollar risk-free rate. Let's take the T-bond rate. The second is what kind of business you're in. If you're in a business which is more discretionary and more risky, you're going to have higher risk. We measure this with a relative risk measure, maybe a beta. But then it also depends on where in the world you invest in. If you're a multinational, let's say you're Coca-Cola, and you're thinking about two projects, a beverage project in Brazil and a beverage project in Germany. Even if you're computing your hurdle rate in dollars, I would expect your hurdle rate for the Brazilian project to be higher than the German project. Why? Because there's more country risk. In other words, the equity risk premiums you saw on the last page are now going to come into play if you're a multinational, and they're going to help you estimate hurdle rates for individual projects. What if you're a multinational? I call these octopus companies. Let's say you're in 5 different businesses, steel, chemicals, whatever, and in 10 different countries. Do you see why the notion of a corporate cost of capital makes no sense? How can you have one hurdle rate across those 50 different cells? Your hurdle rate will depend on what business a project is in, what country you're investing in, and those equity risk premiums become key ingredients. You think that sounds complicated. Well, I didn't create the octopus company. The octopus company did. And if you create these multi-business, multinational companies, you have to deal with the complexity, because the alternative of using one cost of capital across the board will lead the safest parts of the company subsidizing the riskiest parts of the business, and that never ends well. So as a business, that's why you care. You're saying as an investor, why should I care? As an investor, you invest in companies, not in projects. But companies are portfolios of projects, and those projects could be in different parts of the world. So here, the equity risk premiums come in a different way. As an investor, when I think about what rate of return do I need to make on Facebook to break even, that rate of return has to start with a risk-free rate based on the currency I've chosen, the relative risk measure based on the business Facebook is in, advertising, but it also has to reflect the geographical breakdown of Facebook's operations. I like NVIDIA as a company, but if you're valuing NVIDIA as a company, recognize that because their chips are made by TSMC, there's China risk in that cost of equity. I'm not saying this is a positive or negative, it is just reality. So in both business and investing, the equity risk premium plays a role. So if you look at country risk, it plays out both in business and investing. Now, I do intrinsic valuation, so the way I describe to bring in equity risk premiums through a cost of equity is the way I deal with risk. Now, most people think about investing in terms of pricing. Where do I go? Where is it cheapest? And often we use measures like PE ratios and EV to EBITDA or something to compare across companies. Now, I don't want to, to over exaggerate what I'm going to say next, but if my point is right about country risk being different across countries, you should see that reflect the pricing. You should see the cheapest companies in the world, at least in terms of low PE ratios, being the riskiest parts of the world. In this graph, I looked at the EV to EBITDA multiples in July of 2024. I took the aggregate enterprise value in each country, the aggregate EBITDA, and I did it only for countries where there are enough companies, at least 10 companies, so I could do it. So there are big chunks of Africa where I couldn't even compute this, and I computed the EV to EBITDA multiple. It's a mixed bag. There are parts of the world which are red, and these are the parts of the world where the EV to EBITDA is low, and these are risky countries, and that makes sense. But there are also parts of the world where it cuts against the grain, right? France has very low EV to EBITDA, and whatever you think about France, I don't think of it as one of the riskiest parts of the world. Canada and Australia are a contrast, right? Canada is cheaper than Australia. And India in fact, in July of 2024, India collectively had the highest EV to EBITDA of any market in the world. There's more risk in India, obviously, than much of Northern Europe, but there's also more growth. Growth seems to trump risk in many parts of the world. And that net effect is what's driving EV to EBITDA. So as an investor, be careful about investing in companies or countries just because they have low PE ratios, low EV to EBITDA. You got to bring country risk into the discussion somewhere. Now, it might seem strange that I've spent an entire session talking about country risk without talking about currencies. And that's deliberate because I think people make too much of currencies. But you're saying, but risky countries have volatile currencies. You're right. But that's a symptom, not the cause of the problem. Countries with more risky economies, with higher and more volatile inflation, will have more volatile currencies. And I'm going to argue in this last stretch that your currency choice will affect your cash flows and your discount rates, but shouldn't affect your value. You see, how can that be? There's a simple reason. If you choose to value a company and you pick a currency to do the valuation, let's say an Indian company in US dollars, then your discount rate has to be in US dollars. You're going to start with the US T-bond rate as a risk-free rate and build on top of that. You're going to end up with a lower discount rate for that company in US dollars than if you did the cost of capital in Indian rupees. You're saying there, lower discount rates, higher value. Not so fast. Remember, if you estimate your discount rate in dollars, your cash flows have to be in dollars. I have to take my rupee cash flows and estimate them in dollars. You're saying, what does that mean? The growth rates I should be using should be growth rates that reflect inflation in the US dollar, not in rupees. Put simply, if I pick a high inflation currency to do my valuation, my discount rates will be higher and my growth rates will be higher for the same reason, differential inflation. If I take a lower inflation currency, my discount rates will be lower, my growth rates will be lower. You're going to trust me on the math, but if you do it right, your valuation should be currency invariant. But before you get caught up in the mechanics, think of the common sense rationale. You cannot make a great company into an awful company just by switching currencies. That'll be like arguing that the city you live in became cooler just because you chose to report your temperature in Celsius rather than Fahrenheit. Changing what you denominate something in can't make a good company into a bad one or vice versa. So be consistent on currencies. You're saying, what about risk-free rates? Well, if currencies are driven by inflation, you should be able to get the risk-free rate in any currency. In fact, there's a very simple mechanism where you can go from a risk-free rate in one currency to another. For instance, let's say you have the dollar risk-free rate. Let's say you use the T-bond rate as your risk-free rate. And you have expected inflation in the US and expected inflation in Colombia. You can get a Colombian peso risk-free rate by adjusting your UST bond rate, the dollar rate, for the differential inflation. It looks a little messy. There's a shortcut you can use, which is to take the differential inflation, but the right thing to do is reflect the compounding. So if your inflation rate is 3% higher than mine, roughly speaking, your risk-free rate is going to be 3% higher than mine. If you're interested, I used IMF estimates for expected inflation to get the current risk-free rates in 150 plus currencies as an attachment to this session, so you can check it out. Now, not only is inflation the reason risk-free rates vary, it's also the reason why exchange rates vary. You're saying, why would exchange rates enter into investing? Well, remember I said you could value an Indian company in US dollars. To value an Indian company in US dollars, I have to take its rupee cash flows in the future and convert them to dollar cash flows. Let's say I decide to do that. To do that, I need expected exchange rates, the dollar rupee exchange rate in year 1, year 2, year 3. You're saying, how am I going to come up with this? Here's what you shouldn't do. Don't ask an expert or a forecaster. There is a theorem it's taught in the very first few classes of exchange rate, of a currency class, called the purchasing power parity theorem. In other words, the future exchange rate is going to be a function of the spot exchange rate and the inflation rate. Sounds familiar, but differences between the two currencies. So if your currency has a 3% higher inflation rate than mine, roughly speaking, your currency should depreciate about 3% a year. I know that there are deviations from purchasing power parity that can be extensive and last long periods, but if you don't use this in investing in valuation, you will be bringing in views, currency views, into investing in business. That's a dangerous place to be. I want my valuation to reflect what I think about a currency and what I think about a company, and my currency view should be kept separate. So if currency doesn't seem to be the dominant factor in my explanations, it's for a good reason. So country risk is with us, and I hope you get a chance to read the paper if you have the time. But even if you don't have the paper, I hope you have a chance to watch this session and check out the data sets, especially the equity risk premium and data set that I've attached to it. But I thank you very much for listening, and I wish you the best.